All right, as we get ready for your finals, first of all, I want to wish everybody well. It's been a very tough semester in a lot of ways, and I applaud your efforts to get through it and do everything. I think it speaks very well of all of you who've been able to persevere through this. So congratulations on that. Um, all right, I've got 7 problems. I've mailed those to you that I'm going to do in regards to a review for you. Now, remember, in your final, we're only doing the earnings per share calculations and the cash flow statement. A lot of the prior exams that I sent out had, well, they had some error corrections in it, accounting error corrections, uh, which we skipped that chapter. And then, but it was also cumulative. So there were bonds in there and leases in there, and we won't visit that on this particular final. So anyway, here's 7 problems, and so let's go through them and see what we come up with. So the first one here is number 2. DJ Company is a calendar year firm with 120 million common shares outstanding throughout 2013. As a part of his executive compensation plan at January 1st, 2012, the company had issued 12 million executive stock options, permitting executives to buy 12 million shares of stock for $10 each within the next 8 years, but not prior to January 1st, 2015. The fair value of the shares of the options was estimated on the grant day to be $3 per option. The stock options qualify for tax purposes as an incentive plan. The company's net income was $480 million in 2013. Its income tax rate is 40%. The average market price of the stock during 2013 was $12 a share. Okay, so we want to determine the basic and diluted earnings per share. So the basic earnings per share is pretty simple. We simply take the 480 million. This is basic EPS, 480 million. And we had all 120 million outstanding throughout the year. Right, you'll notice that there's no preferred stock. The only thing that we have is the stock options, which does not affect the basic earnings per share at all. And so all we have to deal with here is the shares outstanding. So that's going to be a very easy calculation of $4 per share is the basic earnings per share. Now, on the diluted earnings per share, we have to take into account the stock options. And the reason for this is you want to give investors a clue as to what can happen if those stock options are actually exercised. And so there's 2 things that go on with these stock options. First of all is that we use what's called the treasury stock method. So you'll see that the average price for the stock was $12 a share during the year, and they have the right to buy them for $10 a share. And so even if they exercise these options, we will bring in $10 a share times 12 million shares outstanding. So we will actually bring in $120,000. And so the theory here is that we would buy $120 million worth of shares. Well, if the average price is $12 a share, that would be 10 million shares that we would buy back. And so we're only going to dilute this by 2 million shares. So the idea of using the treasury stock method is we would take the cash that the executives would give us, the $10 for each share, buy treasury shares with that, and then we would only make up the difference with newly issued shares. And so the diluted earnings per share is still going to be the 480 million for the numerator. The denominator is going to be 120 million plus 12 million minus the 10 million. And so that's going to be that'll give us the difference. And again, the way I got that 12 million to me, so the 12 million comes from, that's how many they could buy. And the 10 million comes from, they would give us $12 million times $10 each to exercise the option, which would be 120 million. We would then go in and buy shares at $12 a piece. So 120 million a share divided by 12 would be 10 million shares. So that's where that 10 million comes from. And so we get 480 million divided by 122 million. And grab a calculator here. And that would be $3.93. Round is $3.93.44. So $3.93 a share for the diluted earnings per share on that one. All right. Now, we didn't get heavy into that, and I didn't have a chance to lecture you really well on the options per share. So I doubt you'll see anything that complicated on the diluted earnings per share, but very definitely the basic earnings per share. You need to know those issues. All right, the next one up here is we need to prepare the cash flows from operating section using the indirect method on this. So all sales on credit and accounts receivable increased by $600 in 2013 compared to 2012. Merchandise purchases were on credit with an increase in accounts payable of $400 during the year. Ending inventory was $500 larger than beginning inventory, and income taxes payable increased by $300 during the year. All operating expenses were in cash. Now, in this problem, I gave you income before taxes. Let's see here. Let's assume for our purposes that we've got a 40% tax rate on this problem. And that would be 2,240. And so net income on this one would be 3,360. All right, so now we're going to compare. We're going to do the cash flow from operating activities using the indirect method. So with the indirect method, we start with net income, which we just calculated, 3,360. Then remember, we add back in the depreciation expense. And that was 900 right here. So we add that back in. Okay, now we have to do the inventory. And so inventory, we are told, ending inventory was $500 larger than the beginning inventory. So we're going to subtract the increase in inventory. And then we are also told that merchandise purchases were on credit. And so in accounts payable, with an increase in accounts payable of $400. So we increase the accounts payable, so we're going to increase the cash. Remember, we go the opposite way for current assets. We go the same direction for current liabilities. And so we have an increase in accounts payable, 400. Okay, then we have the accounts receivable. The accounts receivable increased by $600, so that means we sold 600 more than we collected. So again, that'll be the opposite direction, increase in accounts receivable, 600 with that. And then we have the increase in income taxes payable. That's a current liability. And so we go the same direction. And so that would be 300. We would add the increase in income taxes. And so we add that all up. Again, grab the calculator here for this. And I get 3860 on that. Now let's see if that makes sense. 3860, so 9 is plus 4 plus 8 plus 2 plus 5. So yeah, that looks correct. So this is cash flow from operations. All right, so that one takes care of that one. All right, the next one up is number 22. We have Lewis began the year with 300,000 shares of common stock and 25,000 shares of 6% par value cumulative convertible preferred stock. Each share of preferred stock is convertible into 4 shares of common stock. On June 30th, it purchased 10,000 shares of treasury stock. On November 1st, Lewis declared a 2-for-1 stock split, and net income for the year was 850,000. Compute the weighted average shares outstanding stock for the year, the basic earnings per share, and the diluted earnings per share. Okay, so the weighted average shares of stock outstanding, so they begin with 300,000, and that's for the full year, is 300,000. All right, the par value we don't have to worry about for the basic earnings per share, weighted average shares outstanding. It is convertible preferred stock. So when we do the diluted earnings per share, we will have to take that into account. On June 30th, it purchased 10,000 shares of treasury stock. So now we're going to have minus 10,000 times 6/12. That's half a year, so 5, a negative 5,000 for that. And then on November 1st, Lewis declared a 2-for-1 stock split. So remember, we do this in the retrospective fashion, and so it will be the 309. It'll be the 300,000 minus the 5,000 is 295,000, and it's a 2-for-1. So we're going to add 295,000 here. Stock split. Okay, so that's going to be our weighted average shares outstanding will be 590,000 shares for that. All right, so that's part one. Okay, so now we need to do part two, which is the basic earnings per share. So we're going to take the 850,000, and then we have to calculate how much goes to the preferred. So 25,000 times $100 par, $2,500,000 times 0.06. That would be 150,000. So we take the 850,000 minus the 150,000 that is dedicated to the preferred shareholders. Now, there was no indication that we actually declared a dividend. So we only have to calculate the preferred shareholders because it's cumulative. If it had been non-cumulative, we would not have to do that. And now we're simply going to divide that by the number we calculated above, which is the weighted average shares outstanding. So that's going to give us $700,000 divided by 590,000 shares, give us $1.19, $18.6. And that is our basic earnings per share. All right, now number 3, we have to do the diluted earnings per share. Okay, so if we do the diluted earnings per share, that means what we use this in the retrospective fashion, which means that we consider those converted shares to be converted right at the beginning of the year. And so with that one, we're going to eliminate the 150,000. So we just have the 800,000 because we assume no more preferred stock because we assume they were all converted. Each stock is convertible into 4 shares of common. And so we would have the 300,000, the 590,000. But remember, instead of 4 shares, we had that stock split. And so that would be the same as 8 shares or 200,000. So 850,000 divided by 790,000. $790,000. And that will be $1.08 diluted earnings per share. All right, now, just out of curiosity, what would have happened if this number had become larger? So it had been, let's say, $1.21. Then we would not report diluted earnings per share because the shares that were considered to be presumptively dilutive, where they call it anti-dilutive. And so we never report anti-diluted earnings per share. So if this number had gone up, we would not have reported diluted earnings per share on that. All right, so that's our third one. And again, that's probably a little more complicated than you're going to see on the exam, but the basic earnings per share is cents, and then the weighted average shares outstanding, I think you want to be prepared for as well. Okay, number 21 here. Harvey Inc. reported net earnings of $300,000 for the year. Harvey has 200,000 shares of common outstanding all year. 2 years ago, the company granted 20,000 stock options that allow employees to purchase shares for $15 a share. The company stock has averaged $20 in the market during the year. Compute basic and diluted earnings per share. Okay, so the basic is easy. We don't have any preferred stock. All we have is these options. So we're going to take the 300,000 earnings and divide it by the 200,000 shares, and that's going to give us $1.50 for our basic earnings per share. Fairly straightforward on that. Okay, once again, we will do the treasury stock method, and we will consider them purchased at the beginning of the year. And so with that, we have 20,000 stock options times $15 a share. So that would be $300,000 divided by the $20 a share. And so that gives us 15,000 shares. So now we're going to have the 300,000. The numerator does not change. The outstanding shares are still there. Now we're going to do the 20,000 minus the 15, or 5,000 shares. That is additional on that. And when we do that, we get 300,000 divided by 205,000. And I know that's not right. And that will be $1.46 for our diluted earnings per share. Ever do that before? You punch in the calculator and you know that answer is not right. All right. So that's our earnings per share. Here we've got a couple of cash flow ones. This is the cash flow from investing. So we've got Raleigh Corporation's financial statements, including the following amounts during the current year, and we want to know what is the amounts from investing activities. So we issued new preferred stock. That's a financing activity. That's not an investing activity. We loaned cash to a key supplier. That's going to be an investment activity. So that'll be 27,000 there. We bought a new delivery truck. Remember, that's the economic form of investing activity. We sold used production machinery. So that's going to be a negative 23,000. It's kind of an anti-investing or a disinvesting. And then we sold treasury stock. Again, that's a financing. If it's somebody else's stock, it's investing. If it's our own stock, it's financing. All right, so we simply add that all together. And 27 and 52 is 79 minus 23. And actually, I have these signs backwards. These should be this way. They're uses of cash. So this is 79 minus 23 is 56,000 use of cash. So we're down 56,000 in cash because of our investing activities. All right, here's another one, and this is from financing activities. So we retired bonds. That's definitely a financing activity, and that is a negative. So when we retire bonds, we have to pay out cash. We have proceeds from the collection of accounts of a note receivable. That's an investing activity. Dividend received. That is a investing activity. Acquired production machinery, that's an investing activity. And we sold treasury stock, that is a financing activity. So we're down 36,000 on our financing activities for this period. All right, and then our last one, basic and fully diluted earnings per share. We had Woolery had 50,000 shares of common stock outstanding at January 1st, 2016. On March 31st, 2016, an additional 12,000 shares were sold for cash. Woolery also had 4 million in 6% convertible bonds outstanding throughout the year. The bonds are convertible into 40,000 shares of common stock. Net income for the year was 350,000. The tax rate is 35%. Compute basic and fully diluted earnings per share. All right, so our income on the basic earnings per share, we got the 3,500, so we've got that. We don't have any preferred stock, so we don't have to worry about taking any of that out of there. We've only got these convertible bonds, but we do have the 12,000 shares outstand or sold for cash. So we start with 50,000, and that's times 12, so that's 12,000, and that will be times 9 because it starts on April 1st, April, May, June, July, August, September, October, November, December. So that'll be 9/12 or 3/4 or equal to 9,000 shares. So that'll give us a total of 59,000 weighted average shares outstanding on that. So 350,000 divided by 59,000. $5.93 on that one. And then we need the diluted earnings per share. All right, this one gets a little more complicated now. We're going to take the 4 million and we're going to multiply that times 0.06. And so that's 240,000 of interest payments if they convert these that we would not have to make. That means our net income, our income, our operating income would go up by 240,000. But remember, interest is tax deductible. And so we're going to have to take the tax out of that. The tax rate is 35%. So we're going to multiply that times 1 minus the tax rate, which will be 0.65. 1 minus 0.35 is 0.65. And so 240,000 times 0.65 is 156,000. All right, so now we're going to take the 350,000 like we did before, and we're going to add 156 because that's how much more income we would have after tax if we didn't have to make these interest payments. We would then divide that. Now, the bonds are convertible into 40,000 shares. So we're going to take our weighted average shares outstanding of 59,000. And remember, we assume that they convert these at the beginning of the year. So it would be all 40,000 at the beginning of the year. That's going to equal 506,000 divided by 99,000. And that will be 5.11. $5.11 a share, and that's rounded, is 5.11111 ongoing. All right, so that is earnings per share and the cash flow statements. And believe me, if you understand everything that we did here tonight, you will be in great shape on the problem section of the final exam. There are 60 points. There's 4 problems, 2 each earnings per share, 2 each cash flow statement. There's some subparts to some of those, and then there are 30 multiple choice questions worth 2 points each. So, good luck. If you have any questions between now and when you take the exam, don't hesitate to email me. Be more than happy to answer any of those questions, and good luck on this and of course all your finals, and hopefully those of you who aren't graduating I'll get to see in the fall. Those of you who are graduating, good luck, and we hope you won't be strangers once you graduate. Take care.